My name is Jake, welcome to the channel. In today's video, we're gonna talk about the best value sector ETFs out there. So last week we talked about the best growth sector ETFs. A couple of weeks before that, we talked about the best growth ETFs in general, the best value ETFs, monthly ETFs. I've been on this ETF train for last couple of weeks. I just find the topic really interesting, and it's important because, you know, when you think about investing, it's important to understand what options are out there and how to view this. And I love stack ranking different ETFs against each other and kind of benchmarking them because it opens your eyes to how different these ETFs are structured and what the performance has been historically and what you could reasonably project or assume going into the future. Now, obviously, you know, past performance is never a guarantee of future performance, but I really like looking at it because the past doesn't repeat itself, but it does rhyme, and we're going to see a little bit of that here in this video. But if you're just, if you're new to the channel, once again, my name is Jake. I talk about dividend growth investing. I've been on YouTube here for about 4 years. My wife and I, we just reached Barista Fire. But yeah, so here in the last week, nothing's really changed since I uploaded my last video, except, the portfolio is down, like 10 grand. So that's always fun. When I first started investing and when the portfolio was down like 1%, it'd be like, okay, cool, a couple $100, whatever. But now it's like $10,000. And I think, with inflation and everything, dang, I probably could have bought a snow cone at Disneyland. So when making this list of ETFs, these were the things that I really considered. I considered the volatility of the sector itself. I looked at the PE ratio, historical and future projections of the individual sectors. And I made sure that the ETFs were only market cap weighted. I made sure that the expense ratio was low. And most importantly, I wanted to focus on total returns because the total return matters. If you have a massive dividend and really crappy performance in terms of the share price, that doesn't really help you. And that's what a lot of dividend investors get wrong is they look and they'll look at all the different sectors and they'll see, oh, energy has a 4% dividend yield. That means it's the best stock, best sector in the... No, stop it. No, that's not how it works. That's how it works when you don't know any better. Okay. Now, when you educate yourself and you understand that there's more to this than just screening for the highest dividend yield, that's where you really start to learn, and that's where the light bulb comes on. Okay. So we're focusing on the total return, which is the capital appreciation. That's what you see on Google or Yahoo Finance. That's the share price plus the dividend as well. Now, to quote my friend, the world according to Briggs, got it, get it, good. So the ETFs that we're going to take a look at in today's video, the first one is going to be VPU, VDC, VAW, VFH, and VIS. These are all from Vanguard. I just personally, I prefer Vanguard, and that's why I selected all these. You can use other issuers with a similar approach, but I personally went with Vanguard. And it's important to remember that when we think about growth versus value, growth is more focused on future cash flows of the business, and value is more focused on current cash flows, lower PE ratios, companies that are paying a dividend. That's generally what you think about when you think about value versus growth. And it's important to remember that we're talking about value ETFs here. This is not Tesla. This is not Bitcoin. This is nothing that's going to 10x or, you're not going to double your money in a year here. Okay. This is more conservative type of investing. And if you're looking for that 10x overnight growth, you probably would be better off with Bitcoin, and, you can enjoy the volatility that comes with that. And if you do want to go that route, you can. It'll be much faster, and it may look a little like this.
One does not simply walk into Mordor.
Oh my gosh. I almost fell out of my chair the first time I saw that. Oh man, I love it. Best show ever. Not the new one, not the new version, the original. Best show ever. Anyways, so we're going to take a look at the first one here in VPU. This is the Vanguard Utilities Index. All of these ETFs have an expense ratio of 0.1%, so very low expense ratio of what you're getting here. Assets under management, this is the liquidity, this is how popular the ETFs, this is something that I always like to take a look at. And the next thing that we cannot forget is whenever you're looking at an ETF, that you understand what is the index of this ETF. And the index that we're taking a look at for these ETFs, they're all very similar, is the MSCI US Investable Markets Index Utilities 2550. Now, a lot of you are going to be like, what the heck did Jake just say? Well, let me break it down for you. So this is an index that all of these ETFs follow. And if you're unsure of what this is, what you can do is you can Google it and you'll pull up a kind of a fact sheet like this. And this goes for any ETF, by the way, right? So if you go and say, for example, SCHD, you can Google what is the fund methodology of SCHD and you'll be able to find it. Or you can go find it on Seeking Alpha, for example. And then you can Google it and you'll pull something up like this. And what this is focused on, it's focused on the entire US market. So all large, mid, and small cap, they're market cap weighted. It's focused on the utility sector right here. And then if you scroll down in the bottom, you get a little bit more information around the framework of this ETF. But in a nutshell, what this is looking at is it sets rules around the weighting of the individual companies in each of these indices, the index that it's part of, right? So whether it's a utilities or an industrial or a material, they're all the same. They all follow the same methodology. Okay, so very, very important that you understand this. And this goes for every ETF that you ever invest in. Make sure that you know what you're investing in. The next thing that we're going to take a look at here is the holdings. I love looking and seeing what kind of companies are in here. Now, these will not change as often, okay? Because it's just looking at a specific sector. You're not going to see a ton of turnover in these indices because they're focused on a set of companies that generally have been around for decades and are probably not going to go anywhere anytime soon. Okay. The percentages may change a little bit, but not too much. So the top 10 holdings you got, this is what I think is so interesting. So when you think about utilities, generally people think about slow, utilities like, companies that are regulated, that are not growing very quickly. That's not necessarily the case entirely, because Nexter Energy is actually a very fast growing. It's a growth stock in a more conservative value centric index. Okay. I hope that makes sense. So you're getting growth coupled with more of a slow growing, Consolidated Edison, for example. You're getting both of them in this index and they're market cap weighted. And based off of that, you have the allocation, right? So you got Duke in here, you got Southern. Now I own Southern Company and Duke. My wife owns Nexter Energy in her portfolio. Now, if you didn't want to own these companies individually, or you're like, what the heck is a Dominion? What is an XL? What is that? And if you didn't want to get the single stock risk, you could always go with an index like this, and you can get everything in this index. So the two things that I like looking at is looking at the number of holdings in here. There's only 68. This is not a lot. And the top 10 companies in this index comprise of 52% of the index. So this is not very diversified, but you'll kind of see this trend with the other ones because they are sector specific, right? And generally you'll have, a couple of companies in a sector that just dominate the sector. It's just how it works. Okay. And so this is the Vanguard Utilities ETF here. And it's one of the ETFs that I don't personally own today, but if I wanted some extra, yield, this may be something to consider. And towards the end of the video, I'll break down the performance, the dividend yield, and the yield on cost, and I'll break that all down and we'll stack rank all of them. The next one here is VDC. This is the Vanguard Consumer Staples Index. Now, if you watched my last video, this may be a little bit confusing. This ETF is on the growth list as well as the value list. Okay, so that might be like, what? Why is that? Now, it just how it happened when running all of the numbers and looking at everything. This constitutes as a growth ETF based off of the total performance, as well as a value index, because if you look at the holdings in this ETF, you're getting companies like Procter & Gamble, Coca-Cola, but similar to the other one, you're also getting growth stocks in here. You're getting a Costco, you're getting PepsiCo. You'll notice here that there's 108 companies in this index, and the top 10 weighting is 61%. So very, very top heavy, but I personally like this index. If you didn't want to do all the research and invest into these companies individually, I personally think that this is a great approach to get extra exposure to consumer staples without the single stock risk. The next one here on the list is the Vanguard Materials Index. Now, not a lot of people talk about this because this is an index that's more B2B. It's business to business. This is not generally companies that you as a consumer are going to be familiar with, but they're definitely really profitable and mega, corporations out there that you as a consumer benefit from, but you probably don't even know that they exist. For example, if you look at the top holdings, Air Products and Chemicals, you got Nucor, Ecolab, probably some of them you've heard of, but similar to, with the other indices that we took a look at, you'll have growth, but, super growth, but you'll also have more slow growing, more mature companies in there that are growing a bit slower. The top holdings here make up 51% of the index, and there's 118 holdings in this ETF. The next one is VFH. This is the Vanguard Financials. Now, when we go to at the end of the video, you'll notice that this one was kind of difficult for me to add because the total return has been pretty low. And you'll see that at the end of the video, but I included it in here because it has a pretty good, well-rounded, dividend yield. The companies in here, you're going to get the best of the best in terms of JP Morgan, Berkshire, Visa, MasterCard, like really large companies, but similar to the other ones. I don't want to sound like a broken record, but you got S&P Global, you got that in here. You got Visa, which are very growth oriented. And then you have others in here that are a little bit slow growing, right? You got the Bank of America's, Wells Fargo. They're not growing near as fast as, for example, a Visa. And with this one, you have 397 holdings and 43% make up the top 10 weighting in this index. The last one here is going to be VIS. This is the Vanguard Industrials Index, okay? Now, with this one, this is kind of similar to materials. Not everyone's going to be familiar with these companies, but they definitely do exist. And as a consumer, you benefit from the companies that are in here. You just don't maybe necessarily know it, right? So, for example, a couple of them, you got Union Pacific, you got Caterpillar, Boeing, UPS, Honeywell, Raytheon, General Electric, Deere, a ton of great companies in here, okay? And you got in the top 10 holdings, you got 28%, and there's 390 companies in this index. Now, if we were to go and compare the total performance, the total return of these 5 ETFs, and if we were to compare them since January of 2005, the inception date of all of these is in 2004. And so I took January 1st of 2005. The total performance, the highest performer has been VDC. So this is the consumer staples. The second highest has been VIS. This is the industrials. And then the third has been, these are like neck and neck. Third and fourth is going to be VPU and VAW. And then the fifth one, this is what I was talking about earlier. I mean, I have it in here, but it's like, the performance has not been so great. Okay. Now, this does include the financial crisis, which we all know what happened during the financial crisis. Financials have just not recovered as other sectors have since the financial crisis. And if we were to compare this to the S&P 500, let's go on SPY here. If we compare this to the S&P 500, you will see that the S&P 500 has, on a total return basis, has outperformed the majority of these except for VDC. So the S&P 500 has outperformed. So you might be asking the question, well, Jake, why would you ever invest into one of these instead of just the S&P 500? And if you're asking that question, you're thinking in the right direction because it is a very valid question. If you're not beating the S&P 500, then there's got to be a reason behind why you would invest into something else, right? You're paying a higher expense ratio. You're taking on more risk because you're getting less exposure to the overall market, right? And so one reason would be that one of these ETFs, for example, VDC or VPU, they have a higher starting dividend yield. And so if you have a shorter time horizon, maybe you're looking more for yield, and that extra 1.5% can make a massive difference in terms of the cash flow that you're going to be producing instead of having to sell your shares to pay for your living expenses, for example. So there's definitely a reason, but you want to make sure that you plan out why you're investing into maybe something different than the S&P 500 and where that fits into your plan and your goals. Because if you don't have a goal and you don't know what the heck you're doing, you're probably better off in almost every case just going with the S&P 500 until you have a plan and you know what your goal is and why you're investing. Now that feature to add and compare all those different stocks, you will need Seeking Alpha Premium for that. If you want to try out Premium, you can use the link in the description below. With my link, you'll get Seeking Alpha Premium as well as Alpha Picks included in for the price of $249 instead of $438. It's a great way to have access to the different articles on Seeking Alpha. I personally use it every single day. I do all my research on Seeking Alpha. Before using Seeking Alpha, in all honesty, I used to use like 5 or 6 different websites. And now because I have Premium, honestly, I only use Seeking Alpha. And that's just me personally, but I get a lot of value out of it. This is an affiliate link. It does benefit me. If you want to use my link and sign up, I definitely appreciate it, but no pressure. The next thing that I really like looking at is the fund overlap. This is how much overlap there is between different ETFs. For example, if you invest into multiple ETFs. If you watch my other videos, I love comparing ETFs with the total US stock market. I'm kind of a boglehead, but not entirely. I'm not a purist. So don't think that because I'm not, right? So I do invest in individual stocks and different indices, et cetera, et cetera. But I do believe that the closer that you can get to the overall market in terms of exposure, the better off you will be. Okay, so that's my reasoning behind why I value more exposure to the total US stock market just generally, right? But let me give you a few examples. So for example, if you were to invest into the total US stock market in VTI and you wanted to get more yield, you wanted to have a higher dividend yield as maybe a satellite position, VPU only makes up 2% of the overall stock market. So if you wanted to go into 5 or 10% into VPU, you're not getting a lot of overlap. And so in my opinion, that may be something to consider. Now, however, if you only wanted to have 1 or 2 ETFs, then yeah, you probably want more overlap with the total US stock market. So you want to understand how you can benefit, how these ETFs, which are just vehicles, how these vehicles can help you get to your destination. Okay, it's really, really important that you understand that. And when you compare it, for example, with VFH, the financials ETF, there's so much more exposure to the overall stock market. And considering that when you're thinking about building a portfolio and how it fits into your overall goal of your portfolio. So now let's go ahead and let's stack rank all of these ETFs. As I mentioned before, these are all from Vanguard. They all follow the same fund methodology. They all have the exact same expense ratio. They all have the same inception date of 2004. So the expense ratio, if you were to invest $100,000, you're paying about $100 each year that is just naturally taken out of the share price, right? Taken out of the net asset value of the fund. So the first one here is going to be VPU. This is the utilities ETF. It has assets under management of $5 billion, it has 68 holdings. So the least amount here on the list. The top 10 weighting represent 52%. There's 2% overlap with VTI. The total performance, this one has been getting really, really hammered this year, which I think, if you're looking for value, this may be something to take a look at. It's not been performing well. And, who wants to overpay for something? If you're looking for value, this may be something to consider. So the 1-year performance, 14%. 10-year performance annualized, every single year annualized over 10 years has been 8.5%. And that's about what the S&P 500 has done, by the way. So it's keeping up with the S&P 500, which is impressive. And the total performance since 2005 is 341%. The 4-year average dividend yield. So if you were to dollar cost average every single day over the last 4 years, you would have an average of a 3% dividend yield. Whatever the dividend yield is today, unless you're lump sum investing, for the majority of us who don't have money to lump sum invest and you work your day job, that doesn't really matter. What you want to look at is kind of the 4-year average, because that's what you can reasonably assume going forward what the average dividend yield would be. And so it's going to be about 3%. And then the last one here, this is the 10-year yield on cost. If you're just hearing about yield on cost, you're going to love this. This is great. This is, if you were to invest 10 years ago, $100, that $100 is currently yielding 5.7%. Okay, now this is a combination of where the dividend started out 10 years ago, as well as how much it has grown over the last 10 years. Okay, now the reason why I'm sharing this with you is, as I mentioned at the beginning of the video, historical performance is not a guarantee of future performance, but the history does rhyme. And so you could reasonably somewhat assume that, okay, this is kind of the direction that you can kind of assume, all things, remaining equal, right? So that's going to be VPU. The next one is VDC. This is Consumer Staples, has $7 billion in assets under management, 108 holdings, 61% in the top 10 weighting, 6%, only 6% overlap with VTI, 3% performance over the last year, 9% over the last 10 years, and since 2005, 461%, making it the highest performer. That's why it was on the growth list last week. And it has an average 4-year dividend yield of 2.4% and a 10-year yield on cost of 4.6%. The next one is VAW. This is the materials ETF with only $3 billion in assets under management. Not very popular. It's materials, right? And so number of holdings, it's got 118, 51% in the top 10 weighting, only 3% overlap with VTI, 4% performance over the last year, 9% annualized over the last 10 years. Since 2005, it's up 347%. It has a low starting yield, or an average 4-year average yield of 1.8%. So not very high, and it has a 3.5% yield on cost over the last 10 years. Now, VFH, this is the financials ETF. It has $9 billion in assets under management. It is a little bit more popular when comparing this to the others on the list. Has 397 holdings, 43% in the top 10, 13% overlap with VTI. It's been down 1% over the last year. Has a 10-year annual performance of 9.5%. Here's the thing. Since 2005, it's been up 134%. It has a 4-year average dividend yield of 2.3%. And it has a 10-year yield on cost of 4.8%. Now, me personally, with the financials, this may be one that you might want to cherry pick and kind of, I don't like timing the market, but when you see that financials are really, really selling off, what you notice is when financials sell off, they sell off. They drop off like a cliff. So it's something to be mindful of. Surprisingly, there's a ton of volatility. And in 2023, you would think that the financial markets would be a little bit more stable, but I guess that's corruption for you. That's capitalism for you. People are just greedy and things happen. I don't know. I don't want to go too deep down that rabbit hole, but yeah, it's just how the world works, I guess. The last one here, VIS, this is the Industrials ETF, has $4 billion in assets under management, 390 holdings, 28% in the top 10, 10% overlap with VTI, 12% over the last year. It's been doing very, very well. And over the last 10 years, annualized 11%. And since 2005, it's up 415%. However, it does come with a lower 4-year average yield of 1.5%. And yeah, it's got a 10-year yield on cost of 3.3%. So when we look at the best ones, when we look left to right here, the best in terms of the number of holdings, I personally like more holdings, more diversification. That's going to be VFH. The top 10 weighting, the lower the better, in my opinion. There's less, concentration, which I personally prefer. That is going to be the Industrials ETF. The best overlap with VTI, generally, like I said, more is generally better, but it really, you can put an asterisk here. This really depends on your goals. It's going to be VFH, the financials one. In terms of the best performance over the last year, it's going to be VIS. Annualized over the last 10 years, it's going to be VIS, so the industrials. In terms of the best performance since 2005, and you know why I like 2005? 2005 includes the financial crisis of 08 and 09. It includes the interest rate shock of 2018. It includes the pandemic of 2020 and what's going on here in 2022, 2023 with the interest rates. It's done very, very well. VDC, the consumer staples, done very, very well, been very resilient, and it's acting like, because it's so resilient, it's acting like a growth ETF at the same time. So really, really interesting. VPU has the highest 4-year average dividend yield of 3% and the highest 10-year yield on cost. So what does this mean? How can you apply this to your own investing goals, and how could this fit potentially into your portfolio? Well, the way that I look at this, if, for example, you have a lot of exposure to more dividend growth stocks, like, for example, Costco, or something that's growing much quicker but has a lower starting yield, and you want to increase your yield, say, for example, you want to retire in the next couple of years, and you're really heavily invested into SHD or DGRO, and it has like a 2.5% dividend yield, and you want that higher yield, you could look to include VPU or VDC, for example, to up your yield. So there's different ways that you can approach this, and depending on your goals and your time horizon, you can use these ETFs to your advantage so that they fit into your balanced portfolio. So that's how I view it. I hope that this video was helpful. I hope that you learned something new, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.